Well, obviously, I'm not doing as much investing now. I'm more passive, to tell you the truth. Up here, personally, with my own funds, I'm a passive investor. So I'm just an LP now. I actually invest behind some of my top students who have come through the MREX college, who are really strong syndicators now and who really know what they're doing. Um, in the US, I've acted more as an ultra high net worth individual advisor. So the way that I work mostly in the US and also when I was an investment banker in Canada, obviously you really have to, the one thing that people forget about multifamily real estate is that, yes, there's the macro of it. And that's very important. You have to be in tune to what's going macroeconomically. You know, how is job growth going? How is rent growth going? What's happening to vacancies and all that stuff. And you want to look at different market cycles more at the micro level in relation to each other, right? So, I mean, the multifamily market could actually plunge in the US, but that doesn't mean that there aren't metro markets where the multifamily market will be doing very, very well, right? So that's where it gets kind of complex. So we want to look at both things. We want to do analysis at the macroeconomics level, but also at the micro regional level, because multifamily can also be a very regional investment class. And that aside, you also have to do the whole financial engineering side of things where, you know, if you're a syndicator versus just a private landlord, your deal structure is not going to be the same, right? A syndicator is going to have to go for more high value add markets, is going to have to go maybe for a bit more riskier markets that are cash flowing more, because obviously the more risk that you take on in multifamily, the more cash flow you'll have immediately, just because of that whole, you know, IRR, return on risk, return on investment versus risk profile of multifamily. So if you're a syndicator, you know, which I am not really a syndicator. I've educated a lot of syndicators, but myself have worked more with private capital and private equity. So, you know, we've done a lot of deals in more prime markets that we know that, yes, cap rates are low, cash flow is low, but that's because the market possesses very little risk. That's because there's a lot of liquidity in that market, meaning that there are a lot of buyers versus the number of properties in that market, which also means there's a lot of job growth and that rents are going to continue to grow a lot, which is kind of making up for those low cap rates. Like, I take the example of a New York City or Los Angeles or Miami, like any of the major metro markets. Yeah, cap rates are compressed versus Huntsville, Alabama. But the reality of it is cap rates are compressed in those markets because there's so much money in those markets that when you do need to get out of a property, you can get out of it fast, which means there's liquidity, and you won't have to you won't have to give a big premium. You won't have to discount your property that much to move out of it fast. So that liquidity premium is actually one of the major components of what a cap rate is. And also risk. I mean, what's the risk of New York City or Los Angeles or Miami? What's the risk of those markets plunging with regards to jobs and vacancies and rent growth versus Huntsville, Alabama, or Boise, Idaho, or versus Louisville, Kentucky? You know, it's just not the same. And as international money starts to come into multifamily more and more now, what we're seeing, it's only starting to come into multifamily. Like, we've only started to see money coming in from Asia and the Middle East and Europe and even Africa and South America coming into the US, even coming into Canada, into multifamily markets. And that's only just begun. And what that does is you've got all this capital coming in, which continues to compress cap rates. And where does this capital go? It doesn't go to Huntsville, Alabama. It doesn't go to Boise, Idaho, and it doesn't go to Raleigh-Durham. It goes to New York, it goes to Seattle, it goes to Montreal and Toronto and Vancouver, it goes to LA and Miami. So that means that, yes, cap rates might be very low right now, but the rent growth, even if the cap rate stays stable or even actually elevate with the market, the rent growth will probably outplay those cap rates. And that's an important word I just said, probably, right? Because no one has a crystal ball. I don't have a crystal ball. Dr. Mueller out of Colorado, who's the major expert in real estate cycles, or Dr. Lindman out of Wharton, who's one of the major experts in real estate cycles. You know, no one has a crystal ball. I don't have a crystal ball. we're making educated guesses and we're hedging our bets. So I think that's what you want to do, is you want to hedge your bets. And the best way to do that for a smaller investor or for a syndicator is through active portfolio management. That means that when you do your pro formas and your underwriting at acquisition, that's only the first step. You should redo your pro formas and your underwriting constantly, every quarter, every month if you can. And that way, your predictions become less and less predictions as you advance in time, and therefore they become more precise, which also allows you to kind of, reset certain things or make certain protective moves in case your initial predictions of the market were off. So I think that's really where there's a major distinction to be made, because multifamily investors historically, even active investors, have always been very passive, meaning that they analyze the acquisition, they buy the property, and then they manage it, and then they only redo their financials when it comes to refinance in 5 years. And then they're all surprised when, especially now, when cap rates are lower and interest rates are higher, and now maximum loan amounts are getting lower, and they're getting played out of their own properties.